Welcome to lesson 3 of how to become a profitable trader. So my name's Lamar and I've started this channel, Confluent Trading, and I'm going to provide this free course to everyone because I don't think that trading is as complicated as people who charge $1,000 for their courses make it. And it's really not. It's mastering your psychology, mastering your risk management. It's going to help you improve in all areas of your life. I have gone through phases where when I came into financial fortune, I started spending inappropriately. I was not good with my funds and I had no idea how the market moved. I started with Bitcoin in 2013. And so I've seen ups and downs. And at some point it triggered me and I just said, I need to figure out how the market works. And so I learned trading and I knew that if you want to become a great trader, there is no shortcut. And so today we're going on lesson 3. And lesson 3 of the course that explains that there is no shortcut. Here is how you do it, and you need to practice and you need to work hard. So in lesson 1, it was about market structure. Market structure is crucial. Lesson 2 was about levels, key historical levels. And so lesson 3 is going to kind of wrap up how do I find entries, how do I place stop loss, and how do I derive targets. In lesson 4 and 5, we'll begin to go over risk management and psychology, which in reality, those two things are 95% of trading. So in these first 3 lessons, we've just gone over the information, the process. We're going to have gone over the process. And yeah, that's only about 5% of trading. So today's going to be fun. It's going to be exciting. If you have questions, leave it in the comments on YouTube. I'll make sure to reply. If you are interested in following my trades, I have a Telegram channel and the link will be in the description. And if you like the video, give it a like. Otherwise, let's get started. All right, let's get to it. Lesson 3, entry, stop loss, and targets. So first slide, I'm going over risk-reward ratio. Risk-reward ratio is what percentage of your portfolio you're willing to risk versus the profit you're trying to obtain on any given setup. So when I say risk versus reward, then we refer to it as a 1-to-1, or in the second column, 1-to-2, or in the third column, 1-to-3. And so all that means is I'm trying to obtain a 1% reward, but I'm risking 1% of my capital. In the second column, I'm trying to obtain a 2% reward, but I'm risking 1% of my capital. 3% reward, but I'm risking 1% of my capital. So you can see that the capital percentage risk is never going to change. It should not change from setup to setup. We'll go over it in a second, but you're going to pick the percentage of risk of your portfolio, and then you're trying, in theory, to obtain multiples of your risk. So this is your risk versus reward ratio, also referred to as an RR. The RR, profitable win rate calculation. So what is the calculation? How much do I have to win? What percentage do I have to win in order to be profitable, or at very least break even? So you must win at least a certain percentage of your trades in order to be profitable. The lower the risk-reward ratio you target, the higher your win rate must be in order to be a profitable trader. So as an example, on a 1-to-1 risk-reward ratio, I have to win at least half of my trades, 50% of them, in order to break even. On a 1-to-2 risk versus reward ratio, I need to win at least 33% of my trades to be break even. And on a 1-to-3 risk-reward ratio, I need to win at least 25% of my trades to break even. So you can see, if you are obtaining, on average, just say, a 1-to-3 risk-reward during each of your setups, then you only have to be right 25% of the time to break even. So the more you can get out of each trade, the less you have to be correct. But the lower probability, the further away your targets are from your entry, you have a lower probability of the market getting all the way there, and so lower probability of success. So this shakes out. The break-even calculation is basically you take your risk and you add it to your reward. So as in the example, I'm doing the 1 to 2 calculation, 1 to 2 risk reward. So 1 plus 2 is 3. And then you take the reward and you divide it by 3. So now 2/3, the reward versus the total of risk and reward. 2/3 is 66.66 repeating percent. And if you want to know how much you need to win in order to be break even, you just take 0.66666 and you subtract that from 1. And now you're left with 0.3333 down here, and 0.333 is just a representation of 33.3 repeating percent. So that is your break-even win rate. You can basically plug in your risk-reward ratio. If you're looking at a trade setup, or on average trade setups that are 4 to 1, you can take this calculation, plug in your reward here, plug in your risk here, and then handle that formula, and it's going to tell you what you have to do, or how many trades, what percentage you have to win in order to be break even. So anything greater than that should come back to you as profit. If you take all 1 to 3 risk reward ratios and you win 26% of your trades, then you should be a profitable trader. Setup requirements. So it doesn't matter if you use the system that we're going to go over, that we've been going over. If you use any system, any trading strategy you want, it needs to meet these criteria. There's really no exception to that. These criteria are general. Provide a clear, identifiable entry. So it must be a clearly identifiable entry. If you get in a trade and it's difficult day to day to tell if this is the setup, if this is the entry, then you probably don't have a great trading system. It must have a calculated risk per trade. So it doesn't matter who you go to that trades successfully, they all have calculated risk. On Forex, like on Awanda, I use Awanda. Doesn't mean that it's the best exchange to use, but it hooks into TradingView. And if you use that, you can preset your risk on every trade, and a stop loss will be attached to your order. So there's never a reason when trading Forex to not have a stop loss placed. I am not just a proponent of hard stop losses. I am a firm believer that if you trade with soft stop losses, you're setting yourself up for an epic failure. There is no failure besides gaps or slippage in regards to setting a preset stop loss. Have a clear point of invalidation to place your stop loss. So if you get in a trade, you need to know where you are incorrect about your thesis, because any trade setup, any trade strategy has a thesis. And once that thesis becomes invalid, that's when the trader should be out of their trade. And so you have to have a clear point of invalidation when getting into any type of setup. You have to have a profit target that is either 1-to-1 or in excess of 1-to-1 risk reward. You never want to be shooting for less than 1-to-1 risk reward. That does not mean that you're always going to obtain it. That does not mean that if you win a trade that goes bad, you're going to get a 1-to-1. You may only pull out 0.5%, but that's because you'll learn to read the market and read whether your thesis changes as you obtain more data, more candlesticks get printed. But either way, your initial goal on the onset of the trade is to have a minimum of 1-to-1 risk-reward ratio. The process you have, the strategy you have, should be simple enough to be repeated day to day. Day to day, you should be able to say, this is a very understandable process. I can repeat this. I can go through 27 pairs and I can find this type of setup. So you're trying to make something that is repeatable. You also want it to be simple enough that you can explain it to someone in a simple conversation. If you can't explain your own setup fairly simply, I mean, there can be some complexity, but fairly simply, then you have too much stuff going on. You need to simplify it. If market structure is not clear, then you don't need to trade it. And one of the previous videos I said, this chart looks like doo-doo. And if the chart looks like doo-doo, just move on. It's easy. I have 27 pairs I get to trade. If something looks bad, I'm just going on to the next pair. It's not complicated. I don't need to waste any more time looking at the chart. So, oh, nice. Entry triggers. So this is about entry triggers, not intrit triggers. Entry triggers. So entry triggers are basically the signals that you're going to receive once prices reach your point of interest, where you're going to begin looking for your setup. It is the signal you receive that says go, says take the trade. So an entry trigger exists to confirm your thesis. So I see market react at a place that I think it's going to react. It's confirming my thesis. It increases my probability that that level will hold versus me just blindly buying a support level. If I wait to see if the market has any reaction, I've got increased probability of success. And entry triggers should still provide you proper risk to reward ratio, meaning that if I reach a level, I can get the signal that buyers are there, but the signal, once it prints, it could have moved too far away from the really necessary entry zone. It could have taken my risk reward from what would have been maybe a potential 1 to 3 risk reward, and now it's moved so far away so quickly that I couldn't get in the trade, and I'm at a 0.87 risk to reward ratio. So, and I might have said that strangely, but either way, you need it to not be so far from your entry that it removes the purpose of the trade, which is to have probabilities and have an edge. Entry triggers will be presented by the type of candle that forms around that level. So just breaking it into 2 categories. You want to see a wick, or you want to see a strong candle bouncing away from where your entry is, where your entry zone is. So I put examples on the right-hand side. The top 2 examples are the same thing. They're just inverted, but hammer candle would be if you're moving down into a support level, and a long lower wick forms, and buyers buy it up and they hold that level. Now you've got a thesis that buyers have stepped in. It's going to bounce off of your support zone. May not after that, but you have a higher probability. Shooting star is the same thing flipped on its head, but it's moving up into resistance. The buyers try and take it further, and the sellers come down on the market, and they do not allow the price to go further. They leave this long upper wick. Bearish engulfing candle. Bearish engulfing candle is when you've got this green, you're moving up, you get this last green candle, as you can see here, and then a larger consuming red candle closes, and it's greater than the body of the previous candle. So that's a sign that the bears have strength at that resistance. And then the opposite, the bullish candle is we're coming down. The last red candle prints into a key support level, and then a very large, sturdy green candle prints. So now we're thinking, okay, buyers showed their face. They bought it up the minute we got to this major support level. And then the last is tweezers. And so it's basically, tweezers are essentially seeing 2 consecutive candles where long upper or long lower wicks are left hanging, showing that the buyers, in an uptrend, the buyers tried to force it past this resistance twice, and they failed 2 times. And now you'd expect the market to move. Downtrend, sellers tried to sell something through support twice, and the buyers held it together and left these long lower wicks. So those are examples of what you would look at. Preferred candle time frame triggers. So on these time frames, what time frame are these candles that we're looking at as examples? Well, the higher the time frame that is being printed, the higher the probability that the market will react, or the market is going to continue to react with your original thesis. So if I'm looking at the 5-minute candlestick, and I get into a support level and I see a bullish engulfing on the 5-minute candlesticks, it doesn't have as much strength. It doesn't have anything compared to a 4-hour candle close with a bullish engulfing at support. That's going to have a lot of strength and impact the market following that bounce. So higher the time frame, just like our supports and resistance, how strong are they depending on what time frame you're looking at. The same thing. If that candle prints on a higher time frame, it's just going to increase your probabilities of success. Stop loss placement. So as markets moving up in an uptrend, and we're about to show actual examples, but as the market's moving in an uptrend, it's creating, like we discussed in video 1 or lesson 1, it's creating higher highs and higher lows. In an uptrend, stop losses should technically be placed below those recent higher low levels, below the recent higher low structure. In downtrends, we're getting a series of lower lows and lower highs, so your stop losses should technically be placed above a recent lower high structure. So what we're essentially doing is placing it at points where if it is hit, then my thesis starts to become invalid. So we're looking to place it at points where if the market breaches a lower high structure in a downtrend, like we discussed in lesson 1, if you don't know what I'm saying, you need to go back and watch lesson 1. But if it breaches that lower high structure, we've got a potential trend change in play. So we don't want to be in the trade any longer anyway. Placing stop loss below structures will decrease your probability of being stopped out and allow you a chance to close trades early if price action presents weakness. So having it behind reasonable stop loss points, or having reasonable stop loss points, is going to give you time to kind of read the market. If we're forming essentially bottoms and we're trying to short and we notice the market is forming a bottom, we might have extra time to say, you know what, even though it hasn't hit my stop loss, this looks it looks like buyers are stepping in and creating some sort of bottom. But you're also not going to get those unnecessary stop outs. So stop loss does not have to be below lows or highs, below recent lows or above recent highs. But this opens up the opportunity for you to be stopped out on a wick. So if you just place your stop loss at a random point and it has nothing to do with market structure, you could be stopped out of your perfectly valid trade without any actual invalidation. And so placing it utilizing market structure is the ideal scenario. A reasonably defended stop loss is the best stop loss. Then there's kind of the hook of you have to find a balance. That's the last point. Find a balance between stop loss placement and risk reward ratio. So sometimes you've got a strong trend and you may say, gosh, I can get a 1 to 5 risk reward ratio here. That would be very high, but say 1 to 4 risk reward ratio here. And as long as I don't place my stop all the way above the local highs or below the local lows. And so if you've got that strong trend intact, you do have some sort of thesis in place like, I can take a tighter trade here. And if I win, it's going to be such a large amount that the risk is okay. And so you learn that as a trader. If I can find this amazing setup, strong trend, and if I don't place my stop loss behind a high or a low, then I can yield a 1 to 5 risk reward ratio. So I can make 5 times what I'm risking. Then mathematically, me taking trades like that, I only have to be right like less than 20% of the time. So going back to that calculation page, you'll start to realize you have opportunities that present themselves if the market's in the proper mood or moving with enough strength in whatever direction. Then taking those trades with those extremely high risk reward ratios can actually benefit you or be a profitable move in the long run. So there is, as you improve, placing stops behind exact market structure isn't always necessary, but it's preferred if possible. So identifying profit targets. Targets are going to be based on monthly, weekly, or daily key levels. You're going to want to place your profit targets or make your initial targets based on these key levels. You could also have targets based on recent H1 or H4 market structure, but it's preferable that you try and target these key higher time frame levels. The safe strategy, what I would highly suggest to anyone who's just starting to trade, and I use this frequently, it is just a really good strategy to take your money out of the market and move on for free. Win profit reaches a 1-to-1 risk reward. So when you've entered a trade and when you're in a 1-to-1 risk reward profit, close 50% of your position and take your stop loss and move it up to your entry. Move it up to break even. So then now you're in a free trade, and if there is a strong trend, you'll have the ability to ride that trend on the remaining 50% of your position. While you've completely removed risk, you're not going to lose any money now. You're guaranteed a profit. And this is going to be a way, if you're under pressure, if you feel pressure while you're riding a trend, then you're more likely to cut that trade early. So once you've done something like this and you've taken half your profit and you move stop loss to break even, you're going to have this relief. And that relief, that psychological relief, is going to allow you the ability to ride the trend further. Riding the trend is essentially you're trying to catch a larger move. But then, if I'm actually trying to ride a trend, how am I going to maximize my profit? Well, you're never going to get the full move. And if you do get the full move, you're either lying or you were lucky. That's generally a truth. Now, maybe saying, I'm going to close at a key monthly level, then you had your level marked. It was a monthly level. So if the market rejects there, it has a higher probability of rejecting there versus any other point. So there are, you can catch large chunks of move, but the safest thing to do is to scale out of every position. Make a plan and ensure that you retain profits. There should never be a key level that you reach that you do not take at least a percentage of your profit. If the market's trending and we've hit our 1-to-1, we've closed half of the position, we've moved stops to break even, now we finally reached the first daily level, then I need to be at least closing, 10 to 30% of the remaining position at the daily level, at least. And then we blow past the daily. Don't be upset. All you're doing is pulling your money out of the market, because this is one trade. This is a single trade. This isn't everything. And people get so zoned in that they think this trade is everything, and it's not. This is like one trade of the hundreds or 1,000 that you're going to take this year. So don't worry about it. Take your profit, move on. And so you blow through that daily, you get to a monthly. What are you going to do? You're going to take another percentage. And depending on the level, if it's a daily level, you're going to let a larger percentage of it ride. If it's a weekly level, now you're more inclined to close the trade. If it's a monthly, you really should be looking to close the trade, because that's going to be a crucial point. And if it blows through it, you'll find another entry. It's not a big deal. Do not be greedy. Trading is about risk management first and foremost. It's about finding proper entries with proper risk associated with those potential rewards. And it's about not being greedy. When I started, when anyone started, there's maybe 0.1% of people, and I'd say it's probably less, that come in and know how to not be greedy. Oh my gosh, my thing goes to my trade goes to 1-to-2 risk reward. Oh gosh, I'm in 2 times profit. Well, now it's going to go to 3. I know it's going to go to 3. Oh, I'm in 3. This thing's going to go to the moon. This is just going to keep going. Can't you tell? Look at that last candle. No, don't react like that. You have a plan. You need to take money from the market and move on. As soon as you start to feel greed, you either need to get yourself under control or you need to close the trade and reevaluate your emotional state. I mean, if you have a problem with your emotions, attack those head on, because your emotion cannot control your decision making. So here's 2 examples of a choppy market structure setup versus a clear market structure. So on the left-hand side, I've got United States dollar versus the Swiss franc. I've marked out these little highs with A. So these are the highs I'm looking at. And then these horizontals with B. So basically, as we get this first high, and then we get the second high, we get this third high, what do you see? What I see is that the market's not breaching these highs with any integrity, with any strength. It's barely breaching these highs, just barely breaching these highs. And it just continues to barely breach these highs. If you're looking for a setup in here, I think that you're making a mistake. Wait for the market to show clear structure. Right now, it shows weakness. It shows uncertainty, because it really isn't pushing the highs with fortitude. So a potential setup someone would have looked at would have been this high here, and then as we broke above it, this is a structure that I can use to retest, and you can see that it works. The price pushes away, but the problem I have is I've got very poor structure. I've got barely making new highs, but B is you don't want these entries to come back into recent historical market structure. So you can see between point A and B, that last pullback, we actually breached the low. So that shows signal one of weakness. As price moves up, makes a new high, and pulls back to this structure. Signal two is this long is occurring within inside of that previous high-low structure. So here's our previous low. Here's our previous high. So here's our low. Here's our high. Everything happening inside of this structure is not really of interest to you as a trader. You want to see stronger trends than this. You don't want to be taking trades inside market structure, inside that market structure that is immediately to the left of your entry. You want to be in open air is what I'd refer to it as. On the right, this is an example of being in open air. This is ZAR JPY. You are in open air. And so you can see our first high here. We clearly break that high on the second point A of this clear setup. And then where is this entry occurring? This entry is occurring above that local price action. So you see this local structure here that I keep circling with my mouse. Well, we want these entries to occur on top of this structure, not inside of it. You see how this entry is occurring inside of this recent structure. We want this entry to occur above, on top of that recent structure. So we're making clear higher highs, not just barely higher highs, and the entry is occurring atop the structure. So what I've done here is now we're going to go into what triggered the entry. This is the same setup that you saw before. This is this ZAR JPY, but what I've done is I've zoomed into the setup. And so we're going to look for the entry trigger. We're going to decide our stop loss placement, and we're going to discuss the initial targets. So we went atop the structure. We come back to retest these highs. And so now what is going to trigger us into the trade? We've got our zone marked out. These resistance, 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 breaks above, retest. This long lower wick triggered us into the trade. This is an hourly candlestick. I didn't present that on the image, but hourly candlesticks, long lower wick, hammer candle at the bottom, sweeping below these lows, the lows to the left. Now, this is also referred to as a swing failure pattern. That's totally separate. We can go over that in later videos, but this is a great indication that there's strength in the market. The buyer stepped in as soon as it touched our point of interest, and they bought it up. So, and they actually closed the candle positive. I know I don't have green or red candles, but they closed it to the high side. So it was a green candle close. So we get triggered in. Now where are we going to place your stop loss? Well, you have basically four options. You got a little more than four options, but we just use four for this example. You're either placing stop loss below this demand zone right here. So below our first, you see we had support, resistance, resistance, resistance. So I take that, I move it across in a horizontal, and I want stop loss right below there. That's going to be a very tight stop loss placement. Tighter stop loss placements generate higher risk reward. We can see we yield a 2.21, which just means one risk versus 2.21 reward ratio. As we move our stop loss down, you can see our risk reward drops now 1 to 1.48, and we place the stop loss below the swing low, right below the swing low of the structure. And then our third option is below this swing low. We're going below the stop loss structure, and now we're at basically a 1-to-1 flat risk reward. And then we could essentially, the safest, most secure place to put the stop loss, but giving you the worst risk reward ratio, is below the full market structure, down below these lows. But that's yielding a 1 risk to a 0.84% reward. So this is what I talked about 2 slides ago, where you have to find the balance. If you place your stop loss here in this scenario, a wick could have come down here and taken you out of the market, but all that would have been left was a wick. And so you wouldn't actually have been invalidated from your thesis, but you could have gotten stopped out. Now you're going to get a higher risk reward ratio, so you have to be right. You have to win less percent of the trades in order to be profitable. On this scenario, this was going to be really your best scenario where you had a strong stop loss placement while also having a decent risk reward initial. I think that's key too. Initial risk reward ratio. We're riding a trend. We're attempting to ride a trend. So we want targets, we want things to extend beyond these initial highs. So I posted the initial highs for all these trades horizontal to these highs. So that's our target one, is can we re-obtain these recent or local highs? You have options as you get into these trades where, we discussed the safe option, which is as I get to 1-to-1, I close half my position, I move my stop loss to break even. Now it's a free trade. And that would have worked out great in this scenario. But you get to decide what your risk versus your reward is. Me, personally, I would have taken this right here, 1.48. I would have taken that setup, had plenty of room to monitor price and not be stopped out by a wick. Enter with the trend. So as discussed in lesson 1, market structure is dictating the direction you're looking to trade. The more time frames you line up with, so if I'm trading a 1-hour time frame and my market structure on 1 hour is aligned with the H4 and with the daily, then I've got probabilities in my favor. Align with the wind. That's what sailboats do. H4 trend will be your primary focus. So you never really, ideally, until you've gotten good, want to trade against the H4 trend. So whether you're entering on the hourly or the 15-minute market structure, make sure you're at the very least aligned with the H4 trend. That is crucial. It's going to increase your probabilities exponentially. H1 entries are acceptable once the H4 trend is established. That was key. So just making sure everything we've gone over here, we're aligning it with the higher time frame trends to increase our probabilities. So next, we're going to go over live examples. I'm going to do that in a part 2 of this video. So this is all part 1 of the trading system that I'm proposing, and a trading system that I use on a day-to-day basis. And so part 2, I'll go over live examples on ZAR, JPY, perhaps a couple other pairs. We will see. But I hope this all made sense. If it didn't, go back, rewind, pause the video, read the bullet points, review the examples until you understand them, and then hopefully I can add some clarification on the second or part B video. So if you enjoyed this video, give it a like. If you have questions, leave it in the comments on YouTube, and I will make sure to get back to you. Have a great day.